What impacts mortgage rates is this thing called the bond market. When the government needs more money to spend, they issue debt in the form of bonds. Investors buy those bonds and they demand a certain return on that investment. Government says, I need to raise $100. I say, I'll lend you $100 and I want you to pay me interest for the next 10 years on that $100 investment, my buying that bond. Well, if inflation is low, let's say I think inflation is going to be 3%, I might be happy with 3.5% because I know I'm buying the bond just to preserve my money. It's wealth preservation. I'm not looking to get rich off the bond. I'm just looking for a safe place to put my money. So if inflation's at 3%, I might be happy to accept 3.2, 3.3, 3.5% return on that bond. But let's say inflation's at 4%. Am I going to accept a 3.5% return on the bond? No, because I'll lose money over 10 years. Inflation's at 4%. I'm only getting 3.5%. So now I'm going to demand a higher yield on that bond. I'm going to need at least 4%. And if inflation's 4.5%, I'm going to need at least 4.5% return on the bond. And so the higher inflation is, the higher the yield I'm going to require on that bond. And then at the end of the day, that bond, 10-year treasury bonds, whatever they're paying, whatever yield or interest rate they're paying, is ultimately what drives mortgage rates.